Hey everyone, and welcome to Talk ETFs, ETF.com's weekly video series. My name is Sumit Roy, and I'm Senior Analyst here at ETF.com. This week, I'm speaking with Sean O'Hara, President of Pacer ETFs. So, first of all, congrats on eclipsing $40 billion in assets under management. That's quite the feat.
Yeah, I mean, we've had a pretty good year as far as the start goes. I think we ended last year around 35 billion, and we're somewhere around 44 to 45 billion in AUM today. So it's been pretty good.
That's awesome. So, of course, Sean, your cash cow suite of ETFs is powering a lot of the growth of your firm. These are funds that hold stocks with high free cash flow yields. Your biggest cash cow ETF is COWZ, COWZ, followed by CALF, which target large cap and small cap US stocks, respectively. But you have other cash cow ETFs as well. Can you talk about some of those other ETFs that might not get the same level of attention as COWZ and CAF? Why might investors be interested in those?
Sure. So the basic premise behind all the cash cows is free cash flow yield. And we sort of introduced this metric, if you will, 9 years ago as a different way to look at value. Traditional value has been based on low price to book stock investing forever. And you can use a couple of examples, like you can say, well, Kodak was a big company for a long time. And then Steve Jobs invented the iPhone and then Instagram and Facebook. And so no longer do we need that heavy asset industry, but we have a very light asset industry like the cell phone and digital photography. And there's been a shift like that sort of across the board. And so we use free cash flow yield just to try to figure out what stocks are cheap relative to others, pulling 100 stocks out of a broad-based index. What's interesting about free cash flow yield is it has the same characteristics whether you use it for large cap or small cap or international or global. And I'll talk about iCal for international and GCal for global. All of the portfolios exhibit the same basic underlying characteristics. You get better earnings growth. I think this is driven by the fact that you're pulling away from low price to book stocks, which are traditional like utilities, real estate, and financials, and disconnecting from that gives you an opportunity to look at other stocks that can have better earnings growth. You get a higher free cash flow, so you're getting a better return on your investable dollars. And we typically buy those stocks at a pretty significant discount to their PE. So we've also had some success with iCal and GCal. They're both over $1 billion each, and they're growing every day. Not as quickly as COWS or CAF, but there's certainly sizable funds that fill a need for investors. In a traditional asset allocation model, you're going to want to include global and international stocks, and those economies don't generally grow as much as ours do. They're more heavy asset than we are, and so this is just a way to sort of supplement some of those international holdings with a free cash flow yield strategy that allows you to create a portfolio with better earnings growth. And earnings growth is always going to drive stock prices over time. And if I could just mention one last thing, we started the Cash Cow series on focusing on value using free cash flow yield. We've recently launched a series that are focused on growth using free cash flow as a metric as well, but we use free cash flow margin. Free cash flow margin is the free cash flow company gets divided by its sales. And so it's not enough for growth stocks to have sales. Just think of Peloton, right? You have to have sales that are profitable. And so what we're measuring on the growth side is high sales and high sales growth that are profitable. And the characteristics that get exhibited there are you get better earnings growth, you get better free cash flow margins, and you don't pay growth multiples to buy those stocks. You pay sort of broad market multiples. So we think we'll be able to sort of replicate what we've done on the value side with the free cash flow margin as the screen on the growth side.
That's great. And we'll certainly be keeping an eye on those ETFs. Sean, you mentioned CAF a second ago. That's your small cap US ETF. It has about $9 billion in assets under management, and it's outperformed the Russell 2000 over the past year, 12% gain versus 9.7% for that index. But it's been lagging a bit this year with the 8.5% loss versus flat performance for IWM. Why is that?
It's mostly due to some sector exposures and individual stock holdings that are currently in the fund. We're rebalancing actually today and into next week. We've sort of analyzed the performance on all the cows, and in particular CAF. Since we now have 9 years worth of track record, what's interesting is that somewhere around 20 or 25% of the time on a 1 year rolling basis, or short term, we'll lag our benchmark. But when you look at all the rolling 3 year and 5 year periods that follow those, there's no 3 year or 5 year period on a rolling returns basis where CAF or COWS, for example, has underperformed its benchmark. So this actually is probably a pretty good entry point if history is going to be our guide here. When CAF underperforms, when you look out 3 years from now, you get fairly significant outperformance. And it's just a function of what we do. I mean, when you have a different way of weighting an index or you're not owning the whole index, you're going to go through periods where you're going to get really nice excess return. You're going to go through periods where you're going to lag a little bit. The lagging periods tend to be smaller than the higher excess returns. And so I would just say that if people are, if they believe in free cash flow and free cash flow yield, particularly in small cap land, because those stocks are more highly levered than large cap, and about half of their debt is floating rates. So as the Fed has been raising interest rates, it's been more and more expensive. So if you look at the Russell 2000, for example, somewhere like around 30% of those names don't make any money. And when you look at the interest expense compared to EBITDA for that index, they're using like 33 or 34% of their EBITDA just to keep up with financing costs. Whereas when you look at CAF, we don't own any stocks that are profitable, and we're spending like 10% of earnings on debt service. So it's just one of those periods where you sort of go up and down, and it's not something that would concern us because we sort of know the long-term history of the fund.
So, Sean, obviously, CAF is a resounding success, both in terms of performance and in terms of flows. But I did read a critique on X the other day, in which someone said that CAF may have gotten so big that it's now influencing the price of its holdings, which might bode poorly for future returns. How would you respond to that?
I would respond to that two ways. We rebalance every 90 days. And so the portfolio that we're going to have on Monday is going to be fairly significantly different than the portfolio we own today. Somewhere around 30% of the names on average on a quarterly basis turnover. So it's not like we're a constant index that's going to own the same small cap stocks forever. We're more dynamic because of that rebalancing. And so I'm not sure that that's a valid critique of the fund. I think one of the things that we are aware of as the issuer of the fund is that when we do rebalance, we have to be very careful about how we do so. And so the methodology allows for a 5-day transitionary period, for example. And so if we're trying to rebalance out of names where we might be a pretty big holder, we don't necessarily have to do that all in one day. We can stretch it out over 5 days. And we can work with market makers on a whole host of other tactics that we use when we rebalance all of our funds to minimize the price impact, not only of the names that we're going to be moving out of the portfolio, but also, excuse me, the names that are going to come in.
How about COWZ? This is your largest ETF with $23 billion in assets under management. What type of stocks are currently in the portfolio, and do you think it can continue to deliver the returns that investors are hoping for?
Well, the first part's easy. We're overweight energy. We're overweight the consumer a little bit. We've been inching up our exposure to technology. The portfolio, again, will change, going into Monday. If they close today, it'll change going into Monday. So we would expect to see that you'll see some minor adjustments to the overall allocation sector-wise. The big energy names have been good names for us. I don't expect them to completely go away, given where the price of oil is. The second part's more difficult, and that is expectations. So if you keep it in its lane, which is traditional value, we think that over time we'll be able to continue to reproduce the returns that we've got, which have been very, very attractive. One of the things we hear a lot today, Sumit, from financial advisors, is that this market is so highly concentrated in such a few number of names. And that happens every once in a while, but it never lasts. And so when you think about COWZ as a portfolio, I think the current PE is around 11 times earnings, where the S&P is like in the low 20s and the NASDAQ is in the mid to low 30s. And so that puts a lot of pressure on future expectations for those broad-based indexes to continue to deliver the earnings growth. Or we're actually just paying up because we really expect the Fed to pivot hard, which I don't think is going to happen. You can actually buy a portfolio like COWZ, which is 100 stocks that have about 16% earnings growth, and pay 10 to 11 times earnings. Or you can buy the S&P or the NASDAQ, where you might get, say, 10 to 12% earnings growth, but pay 25 to 35 times earnings. And so if you keep it in its lane and you don't compare it to the NASDAQ or to NVIDIA, right, then I think people will continue to get the returns that we think that they should get. And that's based on a longer look over history. But we now have a solid 9-year track record that would indicate that this is something that actually works in real life.
Fantastic. Well, we're going to have to leave it there, Sean. It's been a pleasure having you on the show. Thanks so much for your time.
Thank you. Always a pleasure.